Welcome back to Investing Talk Podcast.
Today we're looking at Micron technology.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are looking at a powerful earnings inflection here. And it seems to be primarily driven by this AI memory supercycle.
Right.
The key takeaway from the latest results is just the sheer scale of the turnaround and, the acceleration.
Turnaround feels like an understatement. I mean, what kind of growth are we actually seeing here year over year?
Well, we saw Micron report a record fiscal Q1 2026 revenue of $13.64 billion.
Okay.
And to put that in context for you, that's up, significantly from $8.71 billion in the same quarter last year. So that's about, 45% YoY revenue growth?
And that momentum isn't slowing down.
Not at all. The guidance for Q2 is set at an astonishing $18.7 billion.
$18.7 billion? That's a huge number for Q2. But, revenue is one thing. What's driving the profit side? Because revenue is great, but margins are what really matter here.
Absolutely. And the gross margins are probably the clearest sign of a structural change. They've rebounded so strongly, and management is now guiding towards 68% non-GAAP gross margins for Q2.
68%?
Yeah. And this margin expansion, it's directly tied to the shift toward high-value memory. For example, cloud memory revenue, that alone reached $5.284 billion.
And the margins on that piece?
66% gross margins on that segment. It just shows you exactly where the profitability is coming from.
That kind of margin level, it just points to serious pricing power. Is that because of supply constraints, or is there a technological advantage at play?
It's a bit of both. Management has been very clear that their calendar 2025 bit supply growth is going to be below industry bit demand growth for non-HBM DRAM and for NAND.
So they're being disciplined.
Extremely disciplined. And you couple that with, skyrocketing AI memory pricing, and it just gives them significant operating leverage. Street commentary even suggests we could see double-digit price increases in the coming quarters.
Wow.
Potentially pushing pricing peaks even higher than that 2018 cycle.
Okay, let's unpack this a bit. If prices are skyrocketing, how is Micron building a sustainable competitive advantage? This is an oligopoly. What stops the other players from just flooding the market?
Their moat is really twofold: technology leadership in high bandwidth memory, or HBM, and their aggressive strategic focus.
HBM is key here.
It's everything right now. The HBM market is projected to grow at a 40% compound annual growth rate. That could reach $100 billion by 2028.
That's a massive market.
It is. And critically, Micron's HBM capacity is or be fully allocated through 2026.
So they're sold out.
Completely sold out. This isn't just about selling a product. It's about having this constrained, high-demand product that locks in your pricing power for the next 2 years.
So they're prioritizing those high-margin AI sales. We saw some news about them making a pretty significant capacity shift.
Precisely. They are explicitly exiting the lower-margin consumer business, crucial, by February 2026.
That's a big move.
It's a huge strategic reallocation. They're moving that capacity directly into higher-value AI server memory. It just amplifies their focus on high-margin segments, and, it seeds the commoditized areas. Analysts are seeing that as a huge net positive.
And it sounds like the company is also diversifying where this high-end memory goes beyond just data centers.
That's right. They're extending their moat into automotive and edge AI. They recently began shipping automotive UFS 4.1 solutions that double bandwidth to 4.2 gigabytes per second.
Which is tailored for what, exactly?
It's for the data-hungry AI models in next-generation vehicles. It positions them as a key enabler in that whole software-defined car market.
And they are backing the strategic focus with some serious cash, right? We heard about a major investment in Japan.
Correct. Micron is funding a significant $1.5 trillion, which is roughly $9.6 billion HBM investment in Japan.
That's a lot of capital.
It is. But what's critical here is that this capacity expansion is supported by Japanese government incentives.
Ah, so that helps de-risk it.
Exactly. It helps them expand their leading-edge HBM capacity while limiting the overall strain on the balance sheet. And at the same time, they're generating huge cash flow, a record Q1 operating cash flow of $8.41 billion, which easily supports their $20 billion CapEx plan for 2026.
All right, let's look at how the market is responding to all these fundamentals. The stock has been on just a massive tear. We're talking soaring between 171% and 240% through 2025.
A huge run.
So when a stock has run that far, the fear is always whether it's overbought or if the momentum is, constructively continuing.
And technical indicators seem to suggest the latter. Despite that huge run, recent trading has been relatively flat.
A consolidation.
Exactly. It's generally interpreted as a constructive consolidation after a vertical move, not a blow-off top.
Hmm.
We're also seeing a classic golden cross setup with the price trading above key moving averages.
Right.
It just reinforces this strong long-term momentum phase. Analysts are interpreting any modest pullbacks as attractive support or new entry levels.
And what about valuation? How does it stack up relative to other big AI players?
That's where it gets really interesting. Despite the massive rally, the stock is trading at roughly 27 times earnings.
Okay.
Now, if you compare that to a peer, like a major GPU manufacturer trading at, say, 31.77 times earnings, it suggests that Micron is actually still undervalued.
Undervalued relative to the AI exposure it offers.
That's the argument. The market might not have fully priced in the durability of these new margins.
We've seen a lot of noise about analyst targets recently. What's the general sentiment there?
The sentiment is overwhelmingly bullish. Analysts have been aggressively raising their targets post-earnings, with multiple firms setting targets between $300 and $338.
So the focus is squarely on the AI pivot.
Completely. The AI memory pivot and the record financial performance. And this conviction is also reflected in institutional flow, with tracking services indicating robust institutional accumulation across the whole AI semiconductor sector.
Okay, with all this bullish momentum and talk of 60–70% margins, we have to address the elephant in the room. Memory is a cyclical business. It always has been. What is the bear case here?
The primary risk is, and always has been, cyclical memory volatility. If Samsung or SK Hynix significantly ramp up supply faster than expected, or maybe if there's a pause in AI server buildouts, it could pressure DRAM and HBM prices.
And those 68% margins would just evaporate.
They'd be the first thing to go, yes.
And given the huge run, is valuation stretched? Even if fundamentals are good, is it just too expensive now?
Yeah, that's the second major point. The stock trades at a large premium to some discounted cash flow, or DCF estimates. This suggests that a pretty significant portion of the expected AI growth is already priced in.
So if there's any disappointment?
If pricing or demand disappoints, the drawdown risk is significant.
So how is the company mitigating these? I mean, these are structural risks that have plagued them for decades.
Well, by prioritizing HBM allocation and maintaining that disciplined supply, as we mentioned, management is ensuring their bit growth is below industry demand, which kind of cushions pricing pressure.
Right.
Plus, that strategic shift away from commoditized segments toward high-margin AI and automotive, that helps structurally reduce their reliance on the old PC and handset cycles. It makes them less susceptible to the classic memory downturn.
And finally, what about the risk around that massive $9.6 billion capex in Japan? I mean, that sounds like a big execution risk.
It is. It's a massive undertaking. It carries execution risk around yields, around customer qualification timelines. However, the mitigation here is pretty robust.
The government support.
That's a big part of it. The Japanese government support meaningfully offsets the immediate capex burden, and the company's improving free cash flow provides a substantial balance sheet cushion to manage those operational hurdles. So ultimately, I think we are seeing a structural shift in Micron. It's moving from being a cyclical player to a core high-margin enabler of this multi-year AI supercycle.
Right.
The key takeaway for investors is that despite the massive gains, the aggressive Q2 guidance, and that strategic capacity allocation to HBM, it suggests the earnings inflection is far from over.
So this seems like a multi-year hold driven by high growth segments and, a new kind of strategic discipline we haven't seen from them before. If you want more in-depth analysis on companies like this, make sure to subscribe to Investing Talk podcast. We'll be back next time with another deep look into the market.